Okay, so 6 hedge fund strategies in the bag. We're nearly there with this hedge fund reading. It might be a nice idea though, if you're considering investing in such a vehicle, to have an idea about what the risk factors are associated with your hedge fund strategy and also what the expected returns might be. Now we know that a lot of these strategies have got quite a high degree of volatility, but just like with traditional assets like equities and bonds, we do have some factor models that will quantify both the risk exposures to various factors and also the expected return that flows from them. So what we're going to have is a conditional linear factor model. Now that sounds very grand and interesting. We've come across these types of models before, or very similar models at level 2. Multi-factor models like the Fama-French model or the Pasteur-Stamba or Carhart, when we're trying to estimate what the expected return is on equity. We're just going to adapt this a little bit for hedge funds. The conditionality is to do with normal market conditions and then turbulent market conditions. So hedge funds often behave very differently in both. So that's where the conditionality comes through. Let's have a look at what looks like a scary model, but hopefully it's not going to be too bad. So what we're trying to find is the return on hedge fund I in period I. Or period T, sorry. And let's just build this up from the ground up. So we're going to have identified, well, N factors. How many are they? So our traditional factor models, if we think of it, well, Fama-French way back in equity in level 2, you're looking at the equity risk. You're looking at book to market value of equity. You've got a size risk factor there as well. The types of risk factors, they're actually on the next slide, that tend to affect hedge funds, things like commodity prices, equity prices, exchange rates, inflation, that sort of thing. So those could be the individual risk factors. So let's just look at factor 1 and factor 2. We're somehow, perhaps linear regression, perhaps simulation, going to estimate our hedge fund's beta factor or its exposure to that risk factor. Okay, so far, so similar to previous factor models we've seen before. The alpha is the intercept. Okay, so in equity factor models, that was often the risk-free rate. Here, it's not defined, it's just alpha. If all of the factors came back 0, we'd end up with a return of alpha. So we've identified the factors which affect our hedge fund. We've identified the sensitivities. It works then just like a normal multi-factor model. But then, once we've done our K number of factors, we split the formula up into its second half, where we've got D. Now D is going to be the incremental increase or decrease in return from each factor in turbulent market conditions. Okay, so really the first half of the formula deals with normal market conditions. The second half, so we're adding the terms in the square brackets, incremental. The incremental difference might be very small. So really D will be a factor which defines that incremental difference. In normal markets, it's going to be a 0. Okay, and then the second half of the formula would simply drop out. In turbulent market conditions, it would be 1, so during a crisis, and then an incremental exposure would follow when you're somewhere in between. So it looks like a scary formula, but actually it's very similar to our well-known and well-loved multi-factor model. In the CFA books, we're given details of a study by Hazanjic and Lowe, who identify 6 risk factors that are most relevant to hedge funds. So equity risk defined by the S&P 500, interest rate risk defined by the Bloomberg Barclays Bond Index, we've got currency risk, the US dollar index, commodity risk, we use our GSCI, total return, credit risk, we're looking at the spread between BAA and AAA bonds, and then volatility risk, we saw this index before, the volatility index, VIX. So 6 risk factors there would be fed into the model. Now, I don't know how many of you are absolutely awesome at your level 2 quants, but you might remember if we're putting together a linear model with lots of factors, we want to avoid multicollinearity. And stepwise regression, very similar model to what we've seen before, would just seek to eliminate highly correlated risk factors. And compared to the previous study of, I'm going to have to just check the name, Hazanjic and Lowe, there we are, apologies for any pronunciation mangles, we eliminate 2 of them. So we keep equity, currency, credit and volatility, but we get rid of interest rate risk and commodity. We reckon that there's just too much correlation really between those 2 risks and the other 4. So we've eliminated those highly correlated risk factors. Ultimately, hedge funds have got various exposures both to those stated risk factors that we've looked at now and some other ones. It depends on the individual strategy of the fund. Okay, just to take us up to the close of the reading then, we're going to be looking at just a few different outcomes of historical assessment, historical analysis of hedge fund returns. So let's have a look at a traditional portfolio. So we're going to start off here with a portfolio, 60% stocks, 40% bonds. Nice, simple asset allocation. What happens when we take 20% of that overall portfolio and put it to hedge funds? Okay, so 20% now goes to hedge funds. The remainder, so the stock and the bonds, they're still there in the same proportion, but this time with 80% rather than 100%. What would happen if we did that? Well, we get lower portfolio standard deviation. You might expect that because of the diversification benefits of hedge funds. Hedge funds individually might have very high standard deviation, but negative correlation with traditional asset classes provides a big diversification benefit to an overall portfolio. A higher Sharpe ratio. Again, I'm sure you guys remember the Sharpe ratio, but just as a reminder, that's the return on our portfolio over and above the risk-free rate per unit of portfolio risk. So higher Sharpe ratios when we throw hedge funds into the mix. We even get higher Sortino ratios. Now, Sortino ratio is very similar to the Sharpe. It's going to be the return on our portfolio over and above a target return. Now, that target return might be the risk-free rate. It might be defined specifically by the investors. And then downside risk only. So we're only looking at downside risk, perhaps more useful for hedge funds than other traditional asset classes. So they're trying to do the same things, the Sharpe and the Sortino ratio. They're saying how much extra return over and above my target or my risk-free am I getting per unit of risk, but the Sortino focuses solely on the downside. And they often, and about 1/3 of portfolios, according to our study, result in lower maximum drawdown. Remember, maximum drawdown, the higher the drawdown, the worse it is for you. The drawdown there, if we just take the dollar value of a portfolio over time, we might see this nice little mountainous graph. The maximum drawdown is the percentage drop between a peak and then the trough. So obviously we'd like that to be as low as possible from a risk management point of view. So sounds great, doesn't it? Lower standard deviation, higher Sharpe, higher Sortino, and lower maximum drawdown. What's not to like? Okay. On the next slide then, we've got the Sharpe ratio definition. We did it on the previous slide. Again, just some facts that have fallen out of historical analysis of hedge funds. Specifically, higher Sharpe ratios tend to come from systematic futures, distressed securities, fixed income ARB, global macro, and equity market neutral. The Sortino ratio, we talked about that a second ago as well, so it only looks at downside deviation. High Sortino ratio specifically, bit of overlap here, so equity market neutral, systematic futures, those were in the previous example, but also long-short equity and event-driven tend to give you a higher Sortino ratio. Okay, just continuing our historical study findings, the most superior strategies overall, systematic futures, equity market neutral, global macro, and event-driven. No guarantee this is going to continue into the future, but it's what we found looking historically. Not really a great improvement, funds of funds and multi-strategy. Remember, those two very similar together. They are multi-manager funds, so didn't significantly improve the risk-adjusted returns. Okay, looking at returns is one thing. What about standard deviation? So the lowest risk, dedicated short bias, and then a bear market neutral. Again, just the findings of our study, no guarantees for the future. Systematic futures, funds of funds, and equity market neutral also reduce standard deviations, but not by as much. And then not really a great impact on standard deviation, distressed securities and relative value, mainly because of their long positions and their leverage. Okay, so we've had a quick history lesson on the effect of a hedge fund strategy on return and on standard deviation. We threw drawdown into the mix a couple of minutes ago. Let's just talk about it again. Remember, that's the peak to trough decline. I drew the picture up just a little while ago. It's expressed as a percentage drop rather than a dollar drop. Smaller drawdowns, obviously the best. So which result in the smallest maximum drawdown? Well, again, you've got global macro and systematic futures. Those tend to keep coming up, don't they? Merger arbitrage, equity market neutral. Again, that's a popular one too. Not really a great impact. Long-short equity, event-driven, and relative value via convertible arbitrage. So for what it's worth, that's what we found in the past. If you're feeling brave, you can go and try and replicate it in the future, although no guarantees can be made. Okay, so that concludes our reading then on hedge fund strategies. We'll see you in the next reading.